Man, it feels like a rough day, but when we look from the high to the low on the S&P 500 recently on this market sell-off, it's 4%. 4%. But let me tell you this. What do we do on days like this when the market really gets hammered? We do this. Hands in pockets. Yep. But we put hands in pockets, we observe, we sit back, we let things come to us, and I have a trade that I'm going to share with you here in a second. So let's take a look here at the SPY. And as I said, just a few days ago, things were looking so amazing. Nothing was going to stop us. And then, bam, you ran into a wall there. So we see the market sell off the last 3 days here. And for technical traders, a lot of times the 3-day sell-off, they'll start to get in here. So that's why I have an opportunity here. But when we trade options, you have to be strategic. You got to be strategic with option trading, and you just can't jump in. And this is what happens to a lot of people, buyers or sellers. Options are messy. You got to be strategic, and I have a strategic trade I'm going to share with you in a second. So let's take a look here at the daily chart. This is a 1 hour. We're going to look at the daily chart here, and when we look at the whole scheme of things, it's just a monstrous run higher here. We're come to the 50-day moving average. We may see a bounce there, but historical and implied has ticked up higher. This is going to affect all our option premium. The thing I want to keep an eye out, though, is 367. That's where the 200-day moving average is at. that's all the way. Looks to be. Let's get a high to low from there. Completely, that's a nearly 12% drop. But from these levels here, it's about 11%. So we could see a bounce here, but this 200-day moving average is something to keep an eye on. I think we get there. I think we eventually get there. We haven't been there since back in last June, but it's looking the way we can get there. The other thing we want to observe here is the VIX, which is relevant because we just looked at the SPY. The VIX is only applied to the S&P 500, which the SPY is the ETF of the S&P 500. So we got a volatility moving up higher here. I think overall it's increased about 67%. So when we look at these spikes higher, they typically fade. Now this is going to affect the premium in options. A lot of people look to sell here, sell options, which could be advantageous and also could not, because you can continue to see a spike higher. But when we look to the left here, notice when we get that spike, we back off. We get the spike, we back off. And this what creates the messiness with options when you trade options. You're long options, or you're on the other side of the option, and you get this big vol expansion, and then you have to either be able to work through it and have enough capital to work through that. So anyways, we get these spikes higher here, back off, spike higher, back off. Now, is this the one that is the mega spike? Well, we probably are seeing a shift in regimes here, meaning that, I think what's coming down the pipe, and we look at all the issues economically, locally, and also on the macro scale, this is, hey, is this the top? No, but we're closer than we were last week, and we're much closer than we were last month, and we're much closer than we were last year. So that's my prediction, or where I stand here. Is it the top here? We could chop around, which we have been for the last few weeks. But again, when you continue to print the money that we continue to print, you have all these other issues. I mean, it's just, you just can't be, there's more risk to the downside there is to the upside. But every bear has said that for the last 10 years. It has been taken behind the woodshed. So VIX here, we also had a short-term volatility, which is volatility on volatility, right? Volatility on volatility. Last time we got that big spike up here, we got a big spike here. This is when the short squeeze, the gamma squeezes were coming in play with the Robinhood traders, the Reddit traders, and so forth. And we can also look back to the last time we got a really big spike was back in the June cycle as well. So those are what we're looking at here, and what we try to look for when I said, put hands in pocket is, hey, let's not get in here, and also we have to be strategic on what we're looking at. If you just buy an option right now, even if prices go higher, so if we buy the SPY, and this is important because we have to go through these simple exercises every time. If you say, Josh, I'm long, I want to get long the SPY, and I'm going to buy the 407 call, which is fine. We can make a theoretical price, and what we're going to see is as prices increase, let's just say we go until tomorrow, and the stock price raises, let's just say $5. Lifts up $5. But volatility is going to drop out probably a good 5 to 10 points. So let's just do 5. We got to do minus. So we can look at a theoretical price here, and the theo on here. So I said the 407, looking right here, and what we're looking at here is, I'm trying to look for the theoretical. Theoretical is 987, and right here on the bid and offer, if you bought, let's say now or going into tomorrow, just to understand the effect of volatility. You paid $9.95, and you see it go higher, up 5 points, but also decreases volatility by 5 points, and you're stuck in the mud. It's a complete wash. So that's the reason why buying options, even if you are right, even if you go a little bit longer, is you have the volatility against you. You have to go really deeper in the money to offset that. We're talking way deep. But I do have another one I want to show you how to be more strategic, and this is an interesting one. So the reason we look at the market and we have different baskets of opportunities, and again, we sit and observe, and that's really the most important aspect of being a trader, being a do-it-yourself trader, independent trader, a retail trader, is you wait for your shots. There's two schools of thought here. The old school thought is you wait for your opportunities and you be patient, you observe, and then when that opportunity triggers, you jump in it and you stick with it. Now, the other school of thought now recently kicked around is to be more active in the marketplace, even if you are on a smaller position size. Why take the risk when you don't have to if you have a system that provides opportunities? That's the tough one, to take your opportunities when they present it and not force opportunities. I'm old school. I come from the floor. So Beyond Meat here is an interesting one. Now, this trigger that I have here, what happens is when there's a 2 standard deviation move that something triggers in these bigger name stocks, that 2 standard deviation move typically is a bounce higher. And this is what we saw here back on the 11th, is we had a big move that that exceeded the 2 standard deviation. There's another trigger in there as well. It's about being oversold or overbought. This is more on the oversold. And what we see here is how to create that. So we had that, looking for the 21st here. So this would have been it. So it looks a little bit different here, but anyways, the trigger there, and what we're looking at is at that time on the 21st, we just looked at the volatility. Volatility expanded because of what was going on in the financial markets. So to be strategic with options, when you play direction, typically you're going to want, if you're buying, you want to buy one and you want to offset volatility. So let's say if we're directional on Beyond Meat, and I think what my trigger, my system says here is that it's a good time to get long to buy. Now you could sell a put spread, but it's not the most ideal. What I would prefer to do is this trade I'm going to look here that triggers more. This is buying one and selling the other. This is more of a diagonal, and what we're looking to do here is, what we're seeing here is that at this point the assumption is it's oversold, and the other aspect of it is on these heavily followed institutional names. There's typically what we refer to as a bid. People looking to accumulate at lower prices. That's how money works. There's always going to be some type of buying, or even on this, over an extension. So if I'm bullish on this, which I am, this is the trade I'm going to be looking to do tomorrow. This is what I'm going to be looking to do. Is I'm going to try to get long this, and I'm going to get long this, doing it with this approach here. So this diagonal here, what I'm looking to do is I am looking to sell the 122 call that expires 30 days from now and get long a longer dated one, and I'm looking to get long the 107 call here. So this is what it looks like. This June 25th expiration, to get long this 107 call here, which is a 50 delta, and to then sell something closer to offset the volatility, is I'm looking to sell the 20 delta option, which happens to be this 125 strike here. So at these prices here, I'm looking to get $2 on this, and to offset the premium paid for the 107, which is about 680-ish. So let's just say $7. So this has a price debit of $4.85. What I'd be looking to do here is I'm bullish, but as prices increase, as we talked about, volatility is going to come out of those options. So the volatility that comes out, which is going to be affected by both, is going to be offset by the expiration for 30 days, the 20 delta one. So the only way to offset an option is with another option. So what we're doing here is a strategic move. It's a diagonal, and this is a way to get long a position using an option, but then to offset the volatility risk by using a different option. So this is specifically a delta directional bet, meaning if I'm bullish, I'm playing delta, I'm playing long here. And I'm using that 20 delta to offset the risk of implied volatility. Now, what I'd be looking to do is writing this all the way into expiration. You can close out depending on however you see your risk and your profit potential. But you can look to write this out all the way to the next expiration, which is 30 days. Let that play out and let this bounce higher here, and be able to look it out. Now, if you get profit as well when prices increase there, you can look to manage it early as well, so you can have two different ways to manage the risk, manage the profit. But what I'm looking here for specifically is now we don't have earnings risk. We have the earnings event out. Prices have sold off pretty aggressively here, and this creates a little bit of opportunity where I have some time. I have offset of volatility as well, and it's a directional bet that Beyond Meat will go higher here. So when we're having this shakeup in the marketplace, especially when we see selling like this, what do? You put your hands in your pockets, you find opportunities, and then you wait to pounce the next day. There's no reason why you have to get in today or any day that you see these sharp sell-offs. Just unplug the system, come back tomorrow, wait for the opportunity, because our capital, not only our emotional, but also our real capital for trades, are essential to being successful long term. So it's not about just taking money, it's about keeping the money as well. So I'll talk to you in the next video. That's what I have for you. Let me know what you think, and we'll talk then.